Hey everybody, and welcome back to my channel. I hope everybody is having a great Saturday. I've been asked by many others on my channel, also family and friends, really to get into what are the tax laws and implications when it comes to stocks. So even though it might not be the most exciting topic, it is one that I'm going to cover today, just to try and help people understand. And for those of you who are new to my channel, my name is Paul Novak, and I absolutely love saving, investing, spending, and talking about money. And that's what we're going to do today. Hopefully you're learning stuff from this channel, you're finding it helpful, and if you are, I would always encourage you to smash that like button and subscribe. Comments are always welcome if you've got questions about what we're going over, or if there's any topic recommendations you have, hence why we're making this video. Post them in the comments down below. Also, if you're interested in saving or you want to start investing, I've got many links posted down below for high yield savings accounts, for brokerage accounts, for investing for children. And with all those links, I've got a lot of promotions and things where you can get free money, free stocks, free lottery tickets. Come check them out. And which I say every single video, please remember, I am not a financial professional. I'm literally just a guy on the internet sharing what I know about personal finance. I'm not affiliated with anybody. I literally only share products I personally use and support. So with that being said, let's get into it. So when I said I was going to talk about tax implications on stocks today and capital gains tax, selfishly, I was kind of excited to cover this topic even for myself. So I know that there are people out there that want to learn about it. I also wanted to do my own research and just find out more information to help me grow. So this week I was equally excited to learn about capital gains as much as I was to share this information with you. And I think it's important for investors to understand what capital gains taxes are, because if you're investing your money in something, you want to make sure you understand everything behind it. And for me, the biggest thing that kept me out of investing in stocks and starting to invest sooner was literally that fear of the unknown. So we're making this video just to try and help people understand more when it comes to capital gains tax. And as I've said with other videos, right, I really only have one regret when it comes to investing, and that is that I didn't get started sooner. And the biggest thing that held me back was just all these different things about stocks that I didn't understand, capital gains tax being one of them. And the next thing that I wanted to stress in this video is I create these videos for beginners. Right? So when I go through these tax laws and things, I'm going to keep this extremely simple. So speaking for myself, when I was a beginner, nothing was more frustrating than trying to do research or learn about this stuff and having it just be over my head. So as we go through this, I promise I'm going to break this down in its simplest form to make it so it's not so darn complicated. And as we get into discussing taxes, the very first thing I want to talk about is that this is specific to taxes on stocks in a brokerage account, such as Robinhood or Charles Schwab, TD Ameritrade. This has nothing to do with tax implications for your 401ks or for your traditional IRAs or Roth IRAs. Those have different tax laws than what the taxable brokerage accounts have. So as I stated earlier in the video, right, I want to keep it simple. I do not like complicated, and I've got great news for you. You can figure out your capital gains tax in only 4 steps. And to be honest, if you're only talking about gains, you can figure it out in 3 steps if you don't have any losses. So this stuff does not have to be complicated. And the other thing that I've got to say is congratulations, because if you've made it to this point in the video or you're looking this up at all, you probably have made some money off of stocks. You're already getting assessed capital gains, which means you're making money. And there's a good chance that this income that you're making is actually being taxed at a lower rate than your wages. All right, and newsflash for everybody, right? Most wealthy people actually end up paying less in taxes than those that are working for wages. And I'm going to explain that a little bit as we go through the video. But when you work for wages, you're taxed at regular income tax rates. So for most people watching this video, my guess is it's probably around 22%. But for the wealthy, depending on how much you make, your taxes you can pay in federal tax can go all the way up to 37%. That is extremely high. When we talk about investments, though, if you're going to get taxed at long-term capital gains tax rates, you're probably only paying 15% on the money that you're making, and at absolute max, 20%. But in order to hit that 20%, you have to actually be making like over $500,000 a year. And my guess is you're probably not making more than $500,000 a year in your income. You know, and to that point, it is kind of sad, but Warren Buffett once said, a direct quote, that he actually pays less in taxes on his income than what his assistants do, right? And he's like one of the biggest investors or known investors in the world. And the reason is because he's paying long-term capital gains on the money that he's making. So his tax rates are lower than his assistants that are actually working for wages. All right, so now let's get into how these taxes get calculated. And like I said, we're going to figure out your gains in just 3 steps. So the first thing we got to talk about is, when do you actually get taxed? I know a lot of people are confused on this. So if you buy a stock, you're holding on to that stock and it goes up in value, some people think, okay, I just made money off that stock, I need to pay taxes. That's not really true. When you're holding on to a stock, whether it goes up in value or whether it goes down in value, those are called unrealized gains and losses, right? So you're not actually paying any taxes at that point. You don't pay any taxes until you actually sell the share of stock. So once that stock, you're not holding it anymore, you sell it, and the money comes back into your brokerage account, that's when those gains or losses go from unrealized to realized, and that's when the tax implications actually hit. So now that you've sold that stock, we've got to figure out one of 2 things. Is your capital gains tax going to be long-term, or is it going to be short-term capital gains? Long-term, to keep it simple, is anything when you've held onto that stock for longer than a year. That means you need to hold onto the stock for 1 year and 1 day. If you hold on to it for exactly a year or anything less than a year, it's considered short-term capital gains, and the tax implications are different with that. All right, so now we know when the gains are realized and unrealized. You should know whether your stock is long-term or short-term based on how long you've held it. Now, short-term capital gains, we want to avoid these at all costs. Short-term capital gains suck. So short-term capital gains are actually going to be taxed at the exact same rate as what your income is. And those rates can range anywhere from 10% down all the way up to 37%. My guess is, like I said, for most people, it's going to be 22%. That's at least where we are. I'm going to post a link down below to the actual tax bracket so you can look at it for yourself. I'm not going to cover all that in this video. But just understand that short-term capital gains, so if you hold your stock for less than a year, are going to be taxed at whatever your income tax bracket is. All right, so now that we're through short-term capital gains, here's where the magic happens, right? This is what you want to get. You want to get to long-term capital gains. And the reason why we want to get there is because the tax implications are much lower. If you could actually get to a point in your life, and you can someday, where you're living off of long-term capital gains, you're going to end up paying only like 15% in capital gains. So I've got over here next to me what those tax rates are. And again, very simple, right? There's only 3 of them. Either you're going to pay 0% in taxes, so you can literally get to a point that your investments you have to pay no taxes on. Your income just needs to be pretty low. And then I'd say for 90% plus of the world, they're going to pay 15%. As you can see here, it's like between 40 and 80,000 all the way up to like 450 to $500,000. Any income in there is going to be at that 15%. And then for some rare people, right, I'm probably never going to hit this point, but if you do make over that, we'll say $500,000 threshold, you're taxed at 20%. But even at that, that's still way lower than what it would be if I was making that money in wages. So that's why you really want to hold on to those holdings for more than a year to get that long-term capital gains tax. All right, so literally that was the 3 steps, right? You've got to realize or figure out when you're actually getting taxed. You've got to figure out whether your taxes are going to be long-term or short-term capital gains, and then you figure out the taxes associated with it. and you know what you're getting taxed off of your stocks. It's not that complicated. But what I want to do is actually just go through a really brief example that'll explain this in further detail. So let's assume you buy a stock and you buy that stock for $100, right? Good news, your stock went up a ton in value. So your stock is now worth $1,100. How you're going to calculate those taxes is you're going to look at the gain. So you're going to take that $1,100 that you have when you sell the stock, you're going to deduct the $100 or subtract it from that initial investment, and you actually made $1,000. That is the gain. So then, as we walk through our example, we've realized it. We know that the gain is $1,000. We've got to figure out the taxes associated with it. We just have to figure out whether that's going to be a short-term capital gain or a long-term capital gain. I'm going to use my taxes for this. So if it was short-term, I'd take that $1,000, I'd times it by 22% for short-term, and I'd find out that my taxes were $220. If it was long-term, which is what I'm striving for, I take that $1,000, times it by 15%, and now you can see my tax implications are only $150. Now, that might not seem like that big of a difference, but we're talking about this on a very small scale, only $1,000. And if I was using this investment as income, right now we're talking $10,000 I'm selling, or even $100,000 I'm selling, right? Those capital gains taxes between short-term and long-term can add up to a lot of extra money. Now, the one thing I do need to warn you guys about, and at the end of the day, if you're having capital gains again, like I said earlier, you should be happy about that. That means that your stocks are making money. But these taxes are not always taken out when you sell the stock. Meaning, when you file your income taxes at the end of the year, you're going to be forced with paying all this in. So when you pay wages, or when you get wages and you get a paycheck, right, those taxes are deducted from your check and paid in over time. The difference with the stocks, that's not always the case. So just be prepared for when you file your taxes, you might actually owe money or have to pay money back in. And that's not a bad thing. Remember, you're making money. It's just don't blow all that money you take out. Make sure to put some aside for taxes and at least prepare yourself. And then just the last thing that I want to talk about, I'm going to go through briefly, is losses, right? So we've assumed in this example that you've made money, which is a good thing, but losses also will impact your capital gains. So we're going to use, for an example, again, we're going to keep it simple, but let's say you made $1,000 on the stock with the example that I just went over. Let's say another stock you sold and you actually lost $1,000. So, you put $1,100 in the market. Now you're going to take your money out. You've only got $100 left because it went down in value. Those two are actually going to offset one another. So if you made $1,000 on one stock, you lost $1,000 on a different stock, you're actually going to pay nothing in capital gains. So, and those losses can actually accumulate, and something that I didn't know before doing this video, you can actually carry them over in different tax years. So again, I'm trying to keep this for beginners. I'm trying to keep this simple. I'm not going to go through all of the tax laws, but I will post a link down below. But I think something to be known is there are maximums to how many losses you can claim in a year, and let's just use, for sake of argument, that's $3,000. But let's say in stocks that you've sold, you actually lost $6,000 throughout the year. $3,000 can get deducted on your taxes this year, and that remaining $3,000 actually will carry over to different tax years. So that's something that I found very interesting. All right, now obviously the math and stuff that I did in here, I kept very simple because I wanted to keep this for beginners. I do want you to know that you will never have to calculate your tax rates. Your brokerage accounts, whenever you get to the end of the year, are going to send you a tax form, a 1099. It'll have all this stuff broken down on it. Odds are you're buying and selling multiple different stocks throughout the years. All you need is this form, and you enter it in when doing your taxes or give it to your tax professional, and everything will be done for you. But at least now you know how those taxes are calculated. So man, wasn't that exciting, right? Taxes, how much more fun does it get? No, but in all seriousness, I really hope you learned something from this video. you find that these concepts aren't as overwhelming as maybe you thought they were, and that's really the point. I want to create these videos to educate others so that, they're not so fearful of investing and they get into it sooner. Like I said, I've said it in this video and many others, right? My biggest regret is not getting started. And I think the biggest thing that held me back was just not understanding this stuff. And really, if I would have taken the time, it's not that complicated. And as I always state, if you're interested in supporting the channel, smash that like button and subscribe. Comments are always welcome if you've got topic recommendations or if you've got questions about what we cover. As I stated earlier in the video, all our links are posted below if you're interested in saving or getting started investing. And remember, I do financial education videos on Saturdays. I do my portfolio reviews on Wednesdays. As I say every video, thanks everybody for watching. I'll see you back here next week to talk about saving, investing, and spending money. Have a good weekend.